Another December webinar, the last one of the year. I can't believe how quick this year has gone. This month, I'm going to do a slightly shorter technical presentation, and that way I'll give Imogen a bit more time. She'll be covering the outlook for 2025 from the strategy team. So if we go on to the slides. So again, I'm only going to look at price. I won't go all through this, but I look at trends, patterns, things that happen. It's all retracements and cycles to me, and we'll see that as we go on. So the first slide is the dollar index. This is very important because it's really given us good clues on the dollar over the last sort of 5-6 years. What we see here is the collapse of the dollar from 1984 down to 2008. Then from 2008, the dollar started to strengthen back up. And where have we stopped? We've stopped the last 3 years at the 38.2% retracement. And I've said that 106.60 area is key. I've said that all year. To get dollar strength, you need to see it holding back above there. And look, this year you're closing right up on that level. So we go to the next slide. This is just the monthly one, just to show how close we are. Every time before, backed off that 38.2% area. But look, here we are, really gunning for it. So December is a bad month, really, because the markets get very thin, year-end liquidity. So we need to see a good confirmed break in full liquidity. But that's the risk for the dollar. If you get above that 106.60, dollar strength to come up towards 109. Where does the dollar strength start to wane? If you get below that 20-period moving average, 104. So I'll start with 104, 106. Above 106 opens up 109. So we go to the next slide. This is the sterling index. So the sterling index hasn't really changed much from what we've been saying for the last few webinars. Price is stalling, and I've been saying watch the 61.8% as retracement, as resistance, and that retracement has held well as resistance. So the last few months, it hasn't managed to break above that. Where's support been? It's simply been at the 50%. So it's just trading between the 50 and 61.8%, just going sideways, really. And what the market needs is to break out of there, but it hasn't got the impetus at the moment. It's done its move from the 38.2. That was the big one, from the 38.2 up to the 61.8%. So you need to break out of those. And again, as I was saying, Christmas is a strange time, thin markets, but I'd like to see a confirmed break in good liquidity for the next signal on the next move. But we'll keep you posted on the webinars if we start to see any evidence of that break coming. So on to the next slide. So this is euro sterling. So I put euro sterling in because a lot of people like to look at how the market is traded on a euro sterling basis. But I'm going to skip the next two slides because what we're going to go to is sterling euro. So just the inverse of this. So we go 2 slides on, please. Yeah, here we go, sterling euro. So what do we see on here? So the first sterling euro chart I've got is the one that just shows the break of the downtrend. So we've broken the downtrend since 2015, and since then prices rallied. Now, we also showed that the lagging line has broken above the cloud, the yellow bit in between, that yellow cloud. So that is positive for sterling. So that's good. But where can we see price stall? We've had the break. We've had a rally up from sort of the 112 area where it broke the trend line up to the 120 area. But where's resistance going to be? So let's look at the next slide. And we'll put on the Fibonacci retracements. And we can see what's stopping sterling euro. It's the 38.2% retracement. Now there's a surprise. So for the last couple of months, this 121.40 area is going to be key. As the market gets close to that, the risk reward isn't that great. If you want to buy sterling, you want to see it above that area, really. I'd say between 121.30 and 122 is the resistance at the moment. And that's the area you need to get above to see the next move up in sterling. The risk is it's resistance. You could see a price pullback on it. So if you do see a pullback off that 121.5 area, 122, where should support be? Well, support should be in the sort of 118.5 area. And if it gets below that, then we have to start to think, is this a bit more serious, this fall in sterling, than just being a pullback within a normal zigzagging market? So 121.5, 122 as resistance, 118.5 as support. Outside those two, something's starting to change. Right, so we go to the next slide. Here's sterling dollar monthly. So on the monthly slide, you can see that this is the same slide we had last month, pointing out the 76.4% retracement that held it at that sort of 133.28 area on a monthly close basis. And it'd been a negative month, so we said, look for a bit of a move down lower again. And we were sort of saying the 126.40, 126.90 area as support. And it went down, it bounced off that area, and it held by the end of the month. It was back above that 20-period moving average. So what can we have here? Well, we know that resistance is probably now going to be in the 129, 130 area. So if you want to see sterling dollar higher and you're saying, is it going to go higher? It needs to break above 129, 130 to stop this pullback becoming more of a serious move lower. Where is the risk on the downside for sterling dollar? Well, the support, if you get my daily charts, we've been saying for about a month now, 124, 125 is the support area. So you need to see it bounce off that and keep the rate towards 129, 130 if you want to see a higher sterling dollar. But at the moment, I just think for the moment, I'd watch sort of 124, 125 to 129, 130, a sort of 5-cent range in December. But what we must be careful of is December is a very thin liquidity month. As the month goes on towards Christmas, liquidity disappears. And then you have that bit between Christmas and the New Year where you get a lot of positioning going on, year-end positioning. So be careful of any false breaks. You really want to see the break, if there is a break, hold in January. So just be careful of false breaks here. The next slide, my final slide, is just the 8-year cycle. So at the beginning of the presentation, I go through like it's all about retracements and mathematical targets. I also put about cycles, and this is an interesting cycle. We've put it all through this year, the 8-year cycle that says sterling normally has a negative year every 8 years. And where's this been really useful, this 8-year cycle? It's the advantage for this chart has been to warn all year when we were up in the 130s and everyone was getting very positive sterling dollar. There was always that risk that sterling dollar would come back to be a negative year. And at the moment, it's slightly negative. Now, we're sort of the first week of December, so that might change in the next 3 weeks. But it has been useful just to sort of temper people's expectations on sterling dollar. Now, the only thing I'll say at the end is, as I've said a couple of times, remember December, thin markets and sometimes false moves. So the last slide I have now, the next slide, is just my disclaimer, which disclaims me of everything I've said. And now I'll hand over to Imogen to give you the strategy team's outlook for 2025.
Good morning, everyone. Thank you very much for joining us. As Piers said, I'm going to just run through some high-level takeaways from our year ahead 2025, which we've published over the last couple of weeks. And then I'll dig in a little bit more in terms of what that means for our outlook for sterling, for euro, and for the dollar. As you can see on the slide that's on the screen, we called our year ahead this year Policy Pendulum, because we really felt when we looked ahead towards the next 12 months that they would be characterized by this policy pendulum swinging towards further fiscal activism, towards terminal rates, and towards global protectionism. And as ever, when we write these documents, you know, we always kind of have to reflect on what's happened over the past 12 months. It's sort of impossible to look ahead without thinking about what we've learned, what the developments have been over the past 12 months. And I think in some ways, it's very fair to say that we will remember 2024 as the year of the ballot box. As we knew when we entered the year, something like more than half the world's population headed to the polls. And what we saw was incumbent governments fare really quite badly in a lot of places as, you know, still high interest rates, still high inflation weighed really on living standards and on consumer confidence. And when we wrote that year ahead 2024, this time last year, one of our key themes was it was called Fiscal Forever. And we wrote that that would really be on the ballot box of a lot of the elections that were taking place in 2024. And I think what we now have as we enter 2025 is not only, was that a kind of campaign promise, but really for many countries, it's now the newly elected reality. Government debt and deficits everywhere have responded to a series of once in a generation shocks, and it doesn't feel like they will be reversing back to more normal levels anytime soon. And it's that shift from kind of very activist fiscal policy away from monetary policy that we think is going to drive particularly rates markets next year. It's this ongoing kind of glut of global bond supply. It's the impact that this fiscal policy is going to have in terms of what it means for inflation, and therefore what that means for, central bank policy everywhere. That is really going to matter. But I think when we think about FX markets, what we saw in 2024 was that it was the kind of different speeds at which central banks were cutting. 2024 was all about that monetary policy pivot, and it was the different timings of those pivots, the different pace of those eventual policy pivots that really drove FX through a lot of 2024. And whilst we don't necessarily think that will be so different in 2025, it might just be a bit less about the timing and the speed of cuts, but actually about where those different landing zones are, so where those terminal rates are. And of course, all of those terminal rates will be very much influenced by these election outcomes as well, what they mean both from a fiscal policy perspective, but of course from a geopolitical and a global trade perspective. And you don't need me to tell you that the outcome of the US election probably influences that very, very heavily. So within our year ahead, as you can see on the screen, we focused on 4 kind of key themes that we really think are going to be the ones that are swinging this policy pendulum towards fiscal activism, towards terminal rates, and towards global protectionism. And that's the path to terminal rates, that's fiscal long COVID, that's changing the changing shape of global free trade, and that is Trump's first 100 days. Let's dig into what this really means then from a currency perspective, and who's going, what this means from an economic perspective for these regions that we are focused on. Before I dig down into the UK, if we could just go onto the next slide, that's great, thank you. I think these charts really illustrate that kind of key theme of the year ahead that I was talking about, that we get this shift away from monetary policy being the key driver of rates and FX markets, or at least away from the speed of policy being the key driver, and towards fiscal policy. What we can see on that left-hand chart is that whilst we do expect to see some rate cuts next year, and even into the end of the year in some cases for the ECB and for the Fed, actually, we think that terminal rates will be reached quite early in the first half of the year, Q1 perhaps for the Fed, a little bit later for the UK and the Euro area, but all of those G3 central banks having reached terminal rates by the first half of the year. And importantly, those terminal rates are quite elevated versus what we've seen in the recent past. Of course, if we go a little bit further back, you would argue that those terminal rates aren't that high at all, as lots of people on my team like to remind me. But compared to recent history, compared to those pre-pandemic years, those terminal rates, which we think central banks will settle at, will be quite elevated. And yet at the same time, and partly because of this, as you can see on the chart on the right-hand side, we have what appears to be a kind of permanent increase in fiscal balances, in deficits globally. You can see that there was a kind of spike higher during the COVID years. And of course, we've normalized somewhat since those real pandemic stresses on government spending, but for the last couple of years and projected well into the future as well, we are in this new higher deficit, higher debt regime. And if we could just skip to the next slide, please. Of course, all of this then has impact on growth. And I think when we think about global growth next year, the really important point to highlight relates to the third part of that policy pendulum swing. And that's this geopolitical risk, this global protectionism risk. I think it's very difficult to argue that a shift even if only incremental, towards kind of deglobalization, towards a global protectionist world, is not going to be a negative for global growth. And that's why we have a relatively downbeat GDP forecast for the world next year. We see just 2.7%, a little bit of a drop-off versus what we've seen previously, but importantly, well below previous cycle averages. And the driver of that low global growth forecast is really about the impact of the kind of weight of global tariffs and global protectionism. You can see how that breaks down in this chart country by country. But perhaps the important points I would highlight, which we'll dig into in a little bit more detail now, is the slowing in the US. So we have the US economy going from 2.7 to 1.7, the pickup in the euro area, and the very marginal but basically stable levels of growth in the UK that we see. So let's talk a little bit about the UK and what is happening there, because I think you would argue really that actually, sterling has performed very well this year. For much of this year, it looked to be the outperforming currency. And a large part of that was driven by a lot of the economic surprises that we saw, particularly in the first half of the year. Growth has evolved actually much better than we had expected, still at relatively low levels, still at levels that are below trend, but much better than we had expected. But the problem is, I think, when we look ahead to 2025, is that the outlook remains pretty poor. And what do I mean by that? Well, really, when we look across the key drivers of growth in the euro area, it's very difficult to see, in the UK, it's very difficult to see what's going to be the engine of growth on a sustained basis through the next few years. We have a consumer that's likely to remain relatively weak, despite the fact that we see some interest rate cuts still. There's going to be an ongoing de facto monetary policy tightening as people roll off onto much higher fixes on their mortgage rate than they have been at. We have a business sector that is facing very similar debt servicing challenges to the consumer, but we have business investment that has essentially been chronically weak in the UK and expected to remain so. One of our fun facts is that if we had remained on the pre-2016 trend for business investment in the UK, it would be 20 percentage points higher today than it is currently. Of course, you would argue that a lot of what has driven that weak capex has been a lack of policy and political certainty. And arguably, we have much more policy and political certainty now in the UK than we did previously. But I would argue that perhaps the policy certainty that we do have isn't necessarily one that's creating an environment or generating the incentives for business investment like the government might have hoped. And so finally, we're just left with government expenditure to drive that growth outlook forwards in the UK. That's what has been driving growth for the last couple of years, and it will continue to support in the near term. But as we all know, the government is sailing very close to the wind when it comes to debt sustainability in the UK, when it comes to those fiscal risks. And there is a limit to how much further that government expenditure can run and just how much further that can support growth. The good news, though, is that inflation has fallen, as we can see on slide 20. You don't need me to tell you that we have come well off those kind of double-digit highs back to much more normal levels. The bad news is that we've probably seen the lows in inflation. We expect it to pick up again in the early part of next year and remain relatively elevated. And so we think it will take quite a while to get back to that 2% target sustainably in the UK. We actually don't see that happening until 2026. In the UK, we essentially see evidence of bigger supply side impairments, which are keeping domestically generated inflationary pressures quite high. And that's what you can see on this chart, shown by the blue lines, that service price inflation, which, as you can see, sort of post-pandemic has remained in a very high and very sticky environment, and we expect that to persist. What does this mean for the Bank of England? Well, we think they will cut rates, as I alluded to previously, but perhaps not very far or very fast. We have the Bank of England reaching a terminal rate of 4%. We see that happening by May, so that would imply cuts in February, March, and May, we think. But I think the near-term risks to that view are actually skewed towards later rather than earlier cuts. So you reach that 4% level, but perhaps after May. Of course, there's a big question around the extent to which national insurance cuts actually have a negative impact on inflation. And ultimately, that might weigh a bit more on the Bank of England's reaction function. But I expect that to be more of a late 2025, if not 2026 story. And so whilst we might settle at a lower level than 4% ultimately, we don't think that that's going to be the case in 2025. And if we could just skip to the next slide, please. This really illustrates the problem that the UK, or the big uncertainty that the UK is facing, is the announcements that we had in the UK budget. And, as I said, that's the big uncertainty for the Bank of England as well. We just heard Governor Bailey this morning making exactly that point, that there's a huge amount of uncertainty in terms of the inflationary and the economic growth impact of the policies that have recently been announced. And so really there's two question marks here for me, particularly when we think about the currency, is are we going to be in an environment where actually the budget and the fiscal policy announcements are positive for the currency because of the impact that they can have from a relative rates perspective, i.e. keeping inflation a bit more elevated than we thought previously, keeping that Bank of England rate a little bit higher? But there's also a flip side. Is this going to be a negative where it dents the attractiveness of the UK? Overseas investors that otherwise would have come into the UK, invested in the UK, particularly given that kind of relative political stability background. And really that's what we need with a current account deficit, to support sterling into next year. We need that overseas investment into the UK. But actually, has the budget dented that attractiveness? And is this going to be a major risk? If we could just skip ahead to slide 24, please. It perhaps won't surprise any of you that we fall a little bit on the more positive side of those questions. That is that we really think this relative rates narrative is going to be a good thing for sterling over the next year. Where it was about this year, those different speeds of central bank cutting, what we think next year is going to be about for sterling is that different landing zone. So the fact that the BOE will be forced to remain at quite a high terminal level, we think, should be a positive and should support sterling into the early part and the back end of 2025. And if we can just skip to slide 25, please, that just reflects that positive sterling view and how we see that playing out in our forecast. So you can see in the second line of that table on the top left there that we have sterling dollar recovering to about 133 by the back end of next year. Now that is in part driven by this relative growth story, and there's a part sort of a marginal dollar downturn story in there, which I will come to. But of course, the risks that we see for sterling are centered both on the growth narrative, so the fact that maybe this economic resilience that we've seen this year fades a little bit more quickly, and perhaps the inflation resilience that we've seen softens a little bit more quickly and forces the BOE to act a bit more quickly than we had expected. But our base case is that we see a gradual sterling recovery supported by relative rates, supported by the carry narrative. Sterling is set to be one of the highest carrying G10 currencies, and we think that will benefit, particularly from an overseas investment perspective. Okay, quickly moving on to the euro area then, please, on slide 26. We actually have a relatively more optimistic growth outlook in the euro area. Our growth number is very similar to the UK. So we have growth next year, we think, at 1.2%. But as you saw in the first chart, when I looked at those growth numbers, that was a much larger acceleration. So that's a rise from 0.7% this year. What's driving that? Well, it's really about this rebound in private consumption that we're expecting. As you can see in the chart on the right-hand side, there's a clear correlation between consumer confidence, between real disposable income, and between private consumption. But what we've seen in recent quarters is a rise in consumer confidence, a rise in real disposable income, and that private consumption leg has lagged a little bit. But we expect that to pick up in 2025, and we think that can support this relatively positive growth narrative in the euro area in 2025. And if we could just get to slide 27, please. And that private consumption, we think, will also be supported by the fact that inflation will be coming down. I think arguably, the euro area is the region where we can see inflationary pressures abating much more clearly. We can see inflation getting back to target on a much more sustained basis than we are seeing elsewhere. And we think that that will necessitate a much easier monetary policy settings from the ECB than what we see from the Bank of England and what we see from the Fed. So we have the ECB cutting at every meeting from here until June, 25 basis points or 0.25%, which would take that terminal rate level down to 2%. That's quite a bit lower than where we see the UK and where we see the Fed. Of course, the ECB, when it started its hiking cycle, started at a lower level, and it never got to quite such high rates. But nonetheless, we see a much easier monetary policy outlook over the coming quarters because of this more benign inflation backdrop. And the other factor helping the euro area or helping the ECB's kind of easier monetary policy narrative is just illustrated on slide 28. And that's the fact that although we talk a lot about this kind of global fiscal narrative, this, high budgets everywhere, ballooning deficits, actually the euro area is a little bit more insulated from that. Currently, the fiscal policy settings for next year are projected to essentially be neutral. I don't think you would describe the euro area's problem as a fiscal problem, but a bit more of a growth issue. There's, of course, two question marks when we think about the fiscal outlook for next year in the euro area. It's how does this evolve post-Trump? Do we need to see more, or are we likely, which we think we are, to see more defense spending, for example? Are we going to see more aid sent to Ukraine if Trump starts to reduce the amount that the US spends? And therefore, do we move away from this neutral fiscal setting towards, like other countries, an easier fiscal setting? But the other question is how will idiosyncratic risks play out? Of course, on aggregate, the euro area's fiscal settings are quite neutral, but as we know and are being reminded very much as we speak at the moment, there are idiosyncratic risks in some countries, and perhaps it's worth highlighting France most clearly here. And you can see on this chart on the right-hand side, which plots the current account balance versus the government budget balance on the x-axis, you can see that France is very much to the left, and the only country that is in fact further left when it comes to the budget balance is the US. So how much are those idiosyncratic risks, both politically and from a fiscal perspective, going to weigh on the euro area and on the currency next year? If we could just skip to slide 29, please. And I think that's really a big question, because we know that these idiosyncratic risks and the impact that they've had on spreads, from an Italy versus Bunds perspective, from a France versus Germany perspective, have traditionally been quite big drivers of the currency in the past. But actually, when we look at the euro on the long-term basis, when we look at our long-term models, as you can see in the chart on the right-hand side, it feels like the euro is actually still too low, or trading at least at the low end of recent ranges. So we see it sort of trapped in this tight range in 2025. And the euro, I think, will be grappling with a few different risks next year. To the downside, you have these idiosyncratic political risks. You also have a more easy monetary policy setting, we think. We have an ECB that's going to cut more, and the risks to that cutting cycle, we think, are to the downside. But on the upside, it's possible that the euro area might benefit from some repatriation of earnings from the US into the euro area as the ECB eases policy a bit more quickly. And whilst you might argue that it feels like the euro area may be a big loser from Trump's incoming president-elect Trump's tariff and trade policies, perhaps first and foremost, the euro area could benefit from not being the main target of his potential tariffs. It really feels like China is going to be the first target, and perhaps that might be to the benefit of the euro area, to the benefit of the euro in the near term. But the main risks, I think, for the euro area next year center on this growth outlook. And if we could just skip to the next slide, I think this makes it clear. We have a relatively buoyant growth outlook for next year. And I think if that doesn't start to materialize, that will be a big risk for the currency. So the table on the top left just illustrates our forecasts. We see euro dollar rising to about 110, so a sort of modest recovery from here, and euro sterling broadly remaining flat through the year. And the charts on the right-hand side just illustrate our quarterly projections and how they compare to sort of market average as we glean from the FX Reuters polls. And then so finally, just to take a couple of minutes to walk through our US projections for 2025. As you can see in the table on the left-hand side, the main impact, I would say, of the outcome of the US election has been for us to revise up our inflation projections. Now, there still remains a huge amount of uncertainty, I would say. I think what we know from the very decisive election victory is some degree of certainty over the direction of travel of policy, particularly when it comes to trade policy, foreign policy, what that means for tariffs, and when it comes to fiscal stimulus. But what is still unclear is what the details are. Who and to what extent is going to be impacted very heavily and first and foremost by these tariffs. So in our baseline projections, we have assumed a 60% tariff on imported goods from China. But as we've learned over the last couple of weeks, there are, of course, other countries that may be at risk. It's still unclear how much of this was a campaign tool, how much of it is going to be a political bargaining chip, or how much of these kind of campaign promises and these early term promises are going to come to fruition. So in our baseline scenario, we've assumed this 60% tariff on imported goods from China, but I would perhaps argue that risks are probably skewed a little bit to the upside in terms of what tariffs may ultimately be enacted. I think we can see, evidently from a lot of his early administration picks that he's put a lot of people in place that are, pro or China hawks and pro Trump sort of tariff policies. So we've revised up our headline PCE forecast. This is kind of the gauge of inflation that the Fed is most focused on in 2025 from 2% to 3.2%. So just over a 1 percentage point rise, and similarly on the core number, a 1 percentage point rise by the end of 2025 on those PCE numbers. Now, it's important to note that this is a temporary rise in inflation, but a significant one nonetheless, and one that, like I say, comes about with a high degree of uncertainty. What does that mean for the Fed? Well, as we illustrate on slide 32, we think that means that there is a little bit more easing to come. We actually have the Fed still cutting in December, and we think they cut again in January and again in March. But that's driven more by the labor market than by the inflation side of things. And so what we see in the labor market is this continued rise in the unemployment rate, we think. We think it peaks at around 4.75%, 4.75%, which would be the highest rate since the summer of 2021. And as we know, the Fed is a little bit different from the ECB and from the BOE in the sense that it has this dual mandate. it has this focus on inflation, but also on full employment. And so the unemployment rate has historically been a very key driver of Fed policy. And we think that there's a perception amongst Fed members at the moment that monetary policy is slightly too restrictive. We're seeing some of the impacts of that in the labour market, and they just want to ease some of that restriction over the next couple of months. But we have the impact of tariffs, as I've just been through, but also the impact of some deportations as well, which Trump has talked about quite publicly, which we think would, ultimately imply some further pressure on wages and on inflation. So we've revised our Fed call following the election, and we now have the Fed delivering just 50 basis points of easing next year, which would take them, like the BOE, to a terminal rate of 3.75% to 4%. So again, very elevated versus even quite recent expectations, but B, very elevated versus where we were sort of in that pre-COVID decade. If we could skip over to the next slide, please. The one projection that we haven't changed since the outcome of the election is on the growth side. And part of that is because we see quite a lot of uncertainty and different levers on the economic growth side pushing in different directions. But part of that is also related to the timing of when different measures will be announced. And we've tried in this slide to sort of illustrate what we think will be the key focuses quarter by quarter for Trump over his first 100 days. And I think what we are already learning, in the fourth quarter of 2024, that foreign policy is really his priority in those first 100 days. And that's going to be the focus for the next couple of months, and certainly through the early part of next year. And as I already went through at the beginning of this call, we see globally, not just for the US, but especially for the US, we see a net negative on growth from what President-elect Trump, we think, will announce from a foreign policy perspective. Offsetting that, though, you have what we think he might announce from a fiscal stimulus perspective. That, of course, has inflationary impacts, but it also has growth impacts as well when we think about the tax cuts that he might ultimately deliver, both for consumers and for businesses. But we think that those tax cuts will probably be delayed until the second half of the year. So we might not see the boost to growth until later on in that, certainly within that first 100 days, but really until later on in the year. And so you've got the kind of negative impact from tariffs and foreign policy weighing first, and then ultimately potentially a positive impact from any fiscal stimulus. And we think the two broadly offset each other. So when we look at growth through the year, we have an unchanged forecast. And like I said at the beginning, that's an unchanged forecast, which shows growth falling from 2.7% to 1.7% next year. So really quite a deceleration through the course of 2025. Well, what does this all mean for FX? Of course, it's probably no surprise, given that we've pared back our expectations for Fed easing, that we've increased our expectations for inflation, and given our base case that we still think these relative rates are going to be an important driver for FX next year. It's no surprise, perhaps, that we have kind of pared back our expectations for dollar weakness through 2025. And if we could just skip to slide 35, please. That really illustrates those kind of tempered expectations for how we see the dollar performing in the top left table there. I think the questions for the dollar outlook now through next year are how much of Trump is really priced? And that's sort of an impossible question to answer at the moment, because there are so many uncertainties. Of course, in many ways, like I said, he's sort of a known quantity. We sort of understand what the direction of travel is going to be, we think, when it comes to foreign policy, when it comes to fiscal policy. But the nuances of those policy measures and the timing of those announcements are very much still unknown. And so it's very difficult to know, how much of the sort of Trump trade is really truly priced in. The second question for me is how much does this weak growth narrative really weigh? You know, I think you would argue, although not aggressively, but really our sort of base case for next year is this end of US exceptionalism, and with it a kind of end of dollar exceptionalism. And of course you can see that in our growth projections. You know, we have it slowing from 2.7 to 1.7%. But how much does that really materialize? Because I would argue that we've been waiting for this kind of end of US exceptionalism for many years now. You know, we, like everyone else, have kind of increasingly pushed back our projections of a US recession over the past couple of years. And so how much can those weak growth outlooks really weigh on the dollar until we start to see the data, or until we really start to see that proof kind of being in the pudding, if you like? And then the final point is, similarly to what we were talking about with the euro area, is how much might this relative growth story really matter for the allure of US assets to foreigners? I think arguably there is a kind of positive outlook from a growth perspective, or certainly from a kind of corporate business perspective, as to what Trump's America First policies might mean. And so to what extent do we see that flip through the year? And some of this relative growth with the US slowing whilst the euro area picks up and the UK remains broadly stable, how much does that influence kind of incoming foreign flows to the dollar, and how much does that ultimately weigh? But as I went through before, we kind of see marginal gains of the euro and of sterling versus the dollar because of this, and because of those relative rate stories that we went through in those respective economies, and the growth story, of course, in the euro area. If we could just skip to the disclaimer slide, please. And I will just say that I will end there and give you all a moment to read the disclaimer that's on the screen. And with that, we will wrap up there. But just a reminder, if you do have any questions on anything that you went through, please feel free to either reach out to either Piers or I directly, or through your NatWest sales contact, and we will be very happy to help. Thanks. See you next month.